Good morning, sir. I can.
Okay, good morning. Okay, so let's quickly start our class so that we can do the little we can this morning. So on our Sunday classes, so last week we looked at IFRS 5 on non-current asset held for sale and discontinued operations. We learned about the criteria for classifying a non-current asset as held for sale. We identified the importance of knowing all of these requirements, which is that the asset must be available for immediate sale and the sale must be highly probable. And we broke down what highly probable means. And we identified the fact that when an asset is held for sale, depreciation will stop on that asset. And we looked at when you have a non-current asset held for sale is measured at the lower of its carrying amount and net realizable value. And when you are classifying a non-current asset held for sale back to its initial states, meaning back to the non-current asset it was before, is going to be measured at the lower of its recoverable amount at the date of reclassification, and its carrying amount after making adjustment for all depreciation that has not been charged since when the asset was reclassified as, or when the asset was classified as held for sale. Then we looked at how a non-current asset held for sale is presented. We said it's presented as a separate line item after current asset. Present it separately like that. We looked at the disclosure requirement. Then we solved some code. And we also looked at discontinued operations, which we said is a component of an entity that is either disposed of or held for sale. And it could either be a separate line of business or a geographical area of operation. And it could just be a plan to sell off. You might not necessarily have sold the component of the entity you might just be planning to sell. And also, discontinued operation can also be a subsidiary that is acquired with the intention to resell. And we said when you have discontinued operation, you have to present that operation separately in the statement of profit or loss under a separate heading known as discontinued operations. And I showed you like now it looks like that means your statement of profit or loss will have continuing operations. You put all the figures for revenue, cost of sales, everything there. And it will also have discontinued operations. Just that for the discontinued operations, you will just have a one-liner item that will show the post-tax profits of the discontinued operations. And you're going to provide the breakdown of this amount in the notes. And if there are any disposal of maybe asset, or probably you sold that discontinued operations and you made profits from that sale, you also bring the profit here under discontinued operations. And we also looked at some disclosure requirements. And we solved this question in class. And I asked you to also attempt some other ones that is similar to that. I'll give you this and also this, similar to the one that we solved before. Now, today, we are looking at IAS 40, talking about investments property. So majorly, what we want to look at majorly is to prescribe. We want to prescribe the recognition and measure.
Kí ló dé? O lè jẹ́wọ́.
Okay. want to prescribe the recognition and measurement of investment property. That's the objective of what we want to look at. So what we need to clarify first is what is an investment, which asset is classified as investment property. So an investment property is the land and building or parts of a building. So the idea is that it could be land and building, or land, it could be just building alone. And it could just be part of a building. It cannot be part of a land because land is land. But it can be part of a building because you could have blocks of flats and you just own a flat of it. And so that's part of a building. Or you could have 7 floors and you own 2 floors in a building. So that's part of a building. So investment property is a land and building, or land or building, or just part of a building that is held for income generation and capital appreciation. That's land and building. So that's investment property that is basically held for income generation or capital appreciation. So the key thing here is that is either land or building, or land and building. That's the key thing you need to hold. So investment property, that's why they call it investment property. But now it is held basically for income generation and capital appreciation. So you are not holding it for production or supply of goods or services. No, those ones are not investment property anymore. Now, a further classification of investment property is that it could be a land that is held for capital appreciation, or a land that is vacant, meaning you are not using the land for anything. So if you have a land that you are not using for anything, it's just there, you don't know what you want to use it for, that is a land that is vacant. It is also held for capital appreciation because the value will go up. So when you hold a land that is vacant, that means we assume that you are holding it for capital appreciation because the value will definitely appreciate, the value of the land will go up. And it could be a building owned, a building held by the owner, the person that owns the building, or held by a lessee, under a finance lease, and is rented out under an operating lease. So when you have a building held by the owner, the person that owns the building, or it is held by a lessee under a finance lease. So if a lessee holds a building under a finance lease, and what you learned under IFRS 16 on finance lease is that when you hold an asset under a finance lease, it means that you are going to use the asset for the most part of the useful life of the asset. Now, you are now renting it out under an operating lease, under a short-term lease. That building is an investment property. That building is an investment. Also, if also if a parent lease a building to its subsidiary under an operating lease. So in the separate accounts of the parent, in the separate account of the parent, the building, in the separate account of the parents, the building will be classified as an investment property because it's renting it out under an operating lease to the subsidiary. However, in the consolidated financial statements, the building will be classified as PP because the group is using it. So as far as the group is concerned, is not rented out because as far as the group is concerned, we do not recognize similar transactions. So if a parent leases a building to the subsidiary in a consolidated account, we will not reckon with that transactions because they will be cancelled out. So when they want to recognize that building in the statement of financial position, it's like PPE, like we are using it for our operations. However, in the parent owns account, he knows that he has leased out a building for income generation, rent. So it would be an investment property in the parent's books. Also, a building under construction to be used for investment property. So you can put it in your books as an investment property as well. So these are the basic classifications that we need to know when it comes to investment property. They are very basic. So don't forget, investment property is nothing beyond land and building that is held for income generation and capital appreciation. That's basically what it is. It's not more than that. Now, the following are not investment property. Number one, land or building held for production or supply of goods or services, or held for administrative purposes. This is a PP So don't get it mixed up. Land or building that you are holding for production or supply of goods or services or held for administrative purposes is PPE. It's not investment property. It is only investment property if you are renting it out. But by the time you are using it, or probably an organization have a building that is used for its head office that you are using your, that one is clearly so that one is clearly a PP because you are using it for administrative purposes. Or if an organization has a land and that land is just there vacant, but it's specifically designated for parking, that this land is for our staff to use it to park. If I may ask you, would that be PPE or investment property? They have a land and they have designated that, okay, our staff will use this land to be parking. We'll use it as a parking space. So if you are the accountant, or based on what I've mentioned so far, how would you classify such a land? Will you classify it as investment property or PPE? Anyone?
Sir, I'll classify it as a PPE, sir.
PP. It's PP, sir.
PPE.
Okay, good. That's correct. So it will be classified as PP because they're using it for administrative purposes. But if they were not using it at all, it's just there, vacant. They don't know what they want to use it for. That one is investment property. That one is clearly an investment property. Also, if you have land or building that is held for sale, okay, this is not investment property, this is an inventory. This is an inventory, not an investment property. Now, when you have an investment property in your books, you need to understand that there could be a partial use of an investment property. So this occur where a building has a component for administrative purposes, and another component, another component for rentals. So it's like you have 5-story building, then 2-story building, 2 floors. In that 5 floors, you are using it for your office, for your head office. And the remaining 3 floors, you are using it for rentals. So how would you classify the building? So the standard says that if the components, if the separate components can be sold separately, or yes, it can be, if it can be sold separately, then the components that is held for rentals should be classified as an investment property, whilst the components that is held for head office of, let me say, for administrative purposes should be classified as PP. So that's if you can sell it separately, that somebody can say, okay, I want to buy this third floor. You can sell that third floor separately. You can sell this other one separately. It's just like you have 10 blocks of flats. You might not necessarily be 5-story building or whatever. And in that blocks of flats, maybe you are using those 2 blocks of flats for your office. You now rented the others out. In your books, when you want to recognize that building, if you can sell each flat separately, meaning that you will know how much you can sell it, then the portion you are using for your office, you put it in your books as PP, as building under PP. The other parts, other blocks of flats that you are renting out, you classify those ones as investment property. Okay, so that's how those ones work. That's how they work. However, if the components cannot be sold separately, so the classification should be based on significance of use. Meaning that if it is the portion that is rented out, that is, if it is the portion that is rented out that is deemed as significant proportion, as a significant proportion, so we will treat or classify the entire building as investment property, and vice versa. Meaning, if it is the portion that you're using for your office or admin that is deemed as significant proportion, we are going to classify the entire building as PP. So, and to determine significance of use, the standard allows management judgment. So use your judgments to determine, okay, which use is significant. The standard allows you to use your judgment. So we're not going to enforce anything on you. Also, we have ancillary services. So these are services that involves the provision of water, security, electricity, and other amenities on the building. If the provision on the building that is rented, okay? If the provision of ancillary services is significant, the building should be classified as PP, and if it is not significant, So in that case, the building should be classified as investment property. So from this explanation, that means if you own an hotel, if you run an hotel business, that means that building will be classified as PP because ancillary services are usually significant in hotel business. You are the one that will provide them water, electricity, a bed, everything. All they just need to come is just to pay you and you provide everything. So that one is beyond holding that building just for income and capital appreciation. That one, you are running a business. That one, you are using it for production of goods or services. It becomes PP because you have to employ people, shelf, a lot of people. But if you have a building, an hotel, and you just signed a management contract with some people to manage it, and you just get a monthly management fee or a monthly income, they just credit your account every month. Yes, that one is investment property because you are not participating in the runnings of the hotel. So substantially, we need to look at ancillary service when we are classifying a building. If the ancillary service is significant, that's PP. That means you are too involved. It's not investment anymore. It's not an investment property, right? So it is only if the ancillary service is insignificant that it still retains its investment property position. Also, is
Sorry, sir.
recognition.
Hello, sir.
Yes, sir.
Hello, sir. Sorry, please. I need to explain that one again. I'm trying to catch something. I didn't get you
Okay.
clear. Can you help me repeat yourself, sorry?
Okay. All right. So I said that if the provision of ancillary service is significant, like somebody that has an hotel, a building that he uses for hotel, and you are the one that is providing water, electricity, everything that they need, all the amenities needed for people to survive in that building. You are the one providing it. That building is PP because that means you are holding that building for provision of services because you have to employ people and do all of that. Employ security, employ chef, employ a manager, all of that. So, but if all you do is just like most landlord, they will just collect rent. You are the one that will provide your electricity. You are the one that will contribute for security. You are the one that will do all of that. That one is still, this ancillary service is not significant. So it's still investment property. It's still investment property. So if you have a building and let's say some people, they would collect money for service charge maybe for a few things, security and all of that. However, if that service charge, some service charge are so significant that in that house, you do little or nothing because you are the one that will provide lights, water, security, all the amenities, and they have an admin building. That one is not investment property to that landlord. That one is PP. Like when there was one company I worked with, they were in 1004. So in 1004, they have admin office there. If you want to buy lights, it's from them. If you want water, just pay. If you want this, just your service charge covers everything. You just go in, sleep, and whatever you need, your personal needs is what you take care of. That one is PP because the owner of that 1004 is running a business. The ancillary service is significant. It's significant. But if it is not, then fine. It's still investment property. I don't know, did that help?
Yeah,
Okay. Now, the person that we're even explaining to, the guy was not even listening. So, recognition of investment property. So, investment property can be recognized if the following criteria are met. Number one is if it is probable that there will be an inflow of future economic benefits, and also it has a cost that can be measured reliably. So if this is just the same recognition criteria for PP, it's the same thing for this guy as well. Also, is measurement of investment property. So initial measurement of investment property is at costs. So you measure it initially at costs, and the subsequent measurements is either you use the cost model or you use fair value model. Okay.
Hello.
Okay. Yeah, me too.
Sorry for taking you back to that instance of PP and not discuss. I just want to ask if what you are trying to say in that, I want to clarify myself. So is it that when those amenities is being used is the major business that the person is doing, that we should classify the building as PPE? I don't know, maybe I'm right.
I didn't even get you. If it's what I didn't hear you.
Yes, I said the auxiliary services being provided, that if it is significant, the significant meaning, the meaning is that to me, I'm thinking that I just want to get it clear that the meaning of this significant means that that is the major business of the building owner, right?
Again, what do you mean by that's the major business of the building owner? So
You said
putting it is not clear.
I didn't get the meaning of that significance of the services very well.
Sir,
Yes.
I think what she's trying to say is that what does the significance implies? So are you
Yes.
saying that what does it implies in terms of the business activities? Does it mean that what the owner is into, that the what is it called? The owner is into, that is doing, that covers the property? That's what it should be referred to as being significant. But the bottom line, what I'm trying to understand is that, or what does it mean to be significant? That's what she's trying to point out. I don't know if
Okay, so I think you're focusing on what you should not even bother yourself so much about. So when you see things like this, from all the standards I've taught you, you should know that one is based on judgment. Nobody can definitely say that, okay, significant means that, it's plenty you're doing. It's just an English word. So yeah, that if anybody look at it, you are the one that is providing them water. You are the one that is providing them security. You are the one that is, so it is not left for you accountants to say, this is significant. This is not significant. So it will be inside your disclosures that, okay, in this building that I rent to, we are the one that is providing them all the amenities they need. So now determine whether it's significant or not is left to your judgment. So the standard will not define, this was significant, this is no one what. That will become rule-based. This is principle-based. So you use your judgment. So the standard allow, let me help you note it down. Just like here now, this partial use, I said we talked about significance of use here. We said that to determine significance of use, the standard allows management judgment, okay? So again, to determine the ancillary services that is significant, the standard allows management. So use your judgment to say, okay, this one is significant. That's why I was able to confidently tell you about an hotel. That one is clearly significant. Again, there are some buildings, and I also give you an example of 1004 that when I was there, they have management office. We usually go there when we want to buy water, when we want to buy electricity, security. We pay huge service charge. They're the one that provide everything. So that one, we see it as, they even have management office. There are some people that have houses, maybe in Lekki, Magodo, and all of that, that they have blocks of flats. That yes, they would provide central generator, they will provide central security, they will provide water, they will ask people to pay service charge. It's significant. If you are the accountant of that person, you can say, okay, it's significant now. You are the one that is providing all the amenities they need to function in this house. Okay, so which is why I did not support when can't remember your name again. When she said that's the business the person is doing, not necessarily. That's not what we're talking about. What we're talking about is that if the amenities you are providing for people staying in that building, if it is a lot, if it is significant, then that means we will see that building, we will see it as you are using it to provide you're using it to provide a service, not just holding it for investment to collect just rent. So what we want you to classify as investment property is that you just collect rent. You are not involved in anything. They just come give you rent. Probably maybe you have an agent, and the agent is not like they are the one that provide water, provide electricity, provide. The people sort themselves out. They just give you rent. Then that one is would fly as investment project. So Ufoma, your hand has been up, so I think you can ask a question.
Hello, sir.
Hello, Ufoma.
Yeah, sir. How can you identify in a real life case that an investment property can either be sold separately or not? How can you identify that?
Yes, so it's quite easy. If it's blocks of flats, for example, now, you know that somebody can buy that. You can easily buy it. That, okay, I want to buy this particular flat. I want to buy that flat and all of that. Also, if you have floors, like 10-story building or something like that, you will know. So the standard didn't tell us that, this is how you will know that you have to sell. You will know now. Whoever, if you want to determine whether you can sell, just look for a real estate person. Okay, if I want to sell this floor, how much will I sell it? And put it on the market and see whether people will come and offer prices for it. Right? So, I mean, it's just about ability to involve experts and know that whether you can sell or not. Right? So there are some that is impossible because of the structure as it is right now. that you cannot separate it. They are already conjoined together. Maybe you have just a 5-bedroom, let's say duplex. So you are now using maybe 2 rooms for your own office. You now rented out the other rooms to different people. That one, you cannot sell it separately. You cannot, except they want to break and separate and do all of that. But as far as we are concerned right now, you cannot sell that one separately. So that's how you look at it. So the standard to a large extent is not rule-based. It doesn't give some specific that this is how you have to do this is how you have to do that. We just give you a guide. You just, okay, if you can sell it separately. So it is now you that will now determine, can you sell, can you not sell? So the standard did not tell us that, okay, this is the one. So we can use our judgment. The same thing for this significance of use, the same thing for ancillary service that is significant. They allow you to decide because there are different types of building and all of that. So we cannot possibly cover everything like that. Okay, so that's for that. So for recognition and measurements, nothing new, similar to what we have done before. So these are the 2 recognition criteria. This is the initial measurement basis, and this is the subsequent measurement basis. For cost model, if you remember, this is costs minus accumulated depreciation minus accumulated impairment losses. While this one is just fair value. Please, this is important, right? Fair value model, meaning that you don't depreciate. It's just fair value. It's just fair value. You do not depreciate. Okay? And additionally, when an investment property is measured using fair value model, any change in fair value should be recognized to profit or loss. Any changes in fair value should be recognized to profit or loss. So this is different from revaluation model that we learned in PP, intangible assets, all of that, where changes in value are recognized to revaluation surplus. But this one, changes in value are recognized to profit or loss. I recognize profit or loss. And finally, you need to make some disclosures for investment property. You need to tell us what's the subsequent measurement model you're using. If you are using cost model, what's the depreciation methods that you're using? What's the depreciation rates that you're using? And also is how you determine the market price or the fair value of the assets. Also, if there are ancillary services, you need to explain to us how you determined ancillary services that are significant. Also, you need to tell us how you determine significance of use, where the components component of a building cannot be sold separately. You need to seriously give, and all this you would mention in the notes to the account. You mention to the notes to the account. So that's investment property, like that. So if you look at these questions here, it says a business owns a building which it has been using as head office. And I said, in order to reduce costs, on 30th June 2019, it moved its head office function to one of its production centers and is now letting out its head office. So company policy is to use fair value model for investment property. The building had an original cost on 4 January 2010 of 250,000 and was being depreciated over 50 years. And I said at 31st December 2019, its fair value was judged to be 350,000. How would this appear in the financial statements at 31st December 2019? Now, if you look at this company, this business has a building that it has been using for head office. So he wanted to reduce costs on 30th June 2019. So he moved its head office function to its production center. So they moved away from that building. So they now decided to be letting out the head office. So, and their policy is that they use fair value model for their investment property. They now told us that when they bought the building on January 10, 2010, they bought it for 250,000 and it's depreciated for 50 years. But in 2019, the fair value is now 350. So how would this appear in the books as at 34 December 2019? So now, this is what so the question above describes what is known as change in use. So there's a change of use from from PPE to investment property, because they were using it for head office before, but now they have decided to let it out. So now the issue is this, when it was PPE from 1st of January 2010 to 30th June 2019. That's like 9.5 years. Maybe? If you count it, that should be 9.5 years. 10, 11, 12, 13, 14, 15, 16, 17, 18. I can't count 19 because now 19 is up to June. So that's half year. That's 9.5 years. So it was investment. It was so the building was a PPE for this period. So now let's get the carrying amount. So the carrying amount